James Rickards is the editor of Strategic Intelligence, a financial newsletter, and director of the James Rickards Project, an inquiry into the complex dynamics of geopolitics and global capital. He's the author of The New Case for Gold and 2 New York Times bestsellers, The Death of Money and Currency Wars from Penguin Random House. He joins the program from the Sprott Natural Resource Symposium in Vancouver. Here at the 2016 Sprott Natural Resource Conference Symposium, and I'm really happy to be joined by Mr. James G. Rickards. You know him, he's the best-selling author of Currency Wars, The Death of Money. His latest book, The New Case for Gold, is also a bestseller. And he also has 2 newsletters that I might mention from Agora Strategic Intelligence and Rickards Gold Speculator. James, once again, it's great to talk to you. Thanks for joining me.
Great to be with you, Albert.
So this is your second time in a row at this conference. What are your views on natural resources in general right now?
Well, I think they have a place in every portfolio. Natural resources is a broad category, so I spend a lot of time writing and thinking about gold, partly because my background is monetary. I'm not a miner or an explorer. I come to gold from the monetary sector, but obviously it's a physical metal. It's got to be mined, so it is in the natural resource category. But there's a lot else there. You're at cobalt miners, lithium miners, farmland, commercial real estate. These all, if not natural resources, are at least in the hard asset category, which I definitely recommend for part of every investor's portfolio. Actually, my favorite natural resource, I certainly recommend gold for portfolios, but I think water is one of the most interesting plays. And a lot of people, they have an intuition about water. I get that. I'm reading about water scarcity and places drying up, and Beijing going from, Beijing's probably a sustainable city of 7 million, has a population closer to 20 million, but in the not too distant future it'll be 50 million. It'll be like Sao Paulo or Cairo or Mexico City or some of these mega cities. They're on a high dry plateau with a lot of pollution. They don't have nearly enough water, so where are they going to get it? We all know the story in California. So I do think that water investing, and there are ways to do it, particularly through a company called Waterfront. I happen to be an investor, and my son's affiliated with that. He's the founder and CEO, so just to declare an interest. But they're doing some very interesting things in the space, and there are other ways to do it. So yeah, whether it's water or some of these important metals, cobalt, lithium, of course, for batteries, gold, which I think of as money, I think they all have a place. And I think any investor portfolio that does not include, I recommend 10% gold, and that leaves 90%, but within the 90% over and above gold, some number, depending on your comfort level, another 10 or 20% allocation to all the other natural resources we talked about. I think that's just prudent.
Yeah, and I can appreciate a guy coming from the finance side getting in this space, because gold really is money, and it's, what would you say, 99% of the people who you rub elbows with don't really appreciate that, understand it, or even revolt against it?
Well, that's probably higher than that. I mean, my favorite quote on gold is from Lord Rothschild in the 19th century. He said, "I only know 2 people who understand gold. Unfortunately, they disagree." So I think that sort of goes to the depth of, your misunderstanding. But here's the source of some of the confusion. People talk about gold as a commodity. It's actually not a commodity. The definition of a commodity is a generic input to another process. So oil is a commodity because you use it in industrial processes. Copper is a commodity because you use it for wires and a lot of other material applications and so forth. They're all commodities. And there are 75 or more grades of oil around the world. There's not one, and only one grade of oil. Gold isn't actually good for anything except money. It's the best form of money. It is money, but its industrial applications are very few. Like really small number. And then people say, well, you got about 17% or 20% of global demand is from jewelry. I consider jewelry, I call it wearable wealth. I mean, maybe there's some decorative art and it looks pretty, but it's just a store of wealth. So I don't really separate between jewelry on the one hand and bullion on the other in terms of preserving wealth. Now, there's a jewelry industry and there's value added in the art. I get all that, but I really put them in the same category. So gold has no use except as money. That's why it's not a commodity. Now, people will talk about gold as an investment. Oh, I'm allocating my investment. It's not really an investment because it has no yield. I mean, investments have yield. You take risk. People say that's a disadvantage for gold. Well, not really. Take a dollar bill out of your wallet and hold it up, or Canadian dollar, U.S. dollar, whatever, and hold the bill in front of you and say, what's the yield? There is no yield, right? Because money doesn't have a yield. If you want yield, you have to go put it in the bank or buy a share of stock. And people say, well, my money's in the bank. Well, no, your money's not in the bank. A bank deposit is an unsecured liability of a possibly insolvent financial institution. That's what a bank deposit is. You can call it money if you want to, but it's not really money. And when the bank wants to shut its doors, or the deposit insurance runs out, or you have an amount in excess of the deposit insurance, or they do a bail-in, as they will, you're going to discover the hard way that it's not money. Same with money market funds. So I'm not saying they're horrible investments. I'm not saying you shouldn't put any money in the bank. What I'm saying is don't think it's money. So the fact that gold has no yield makes sense to me, because money has no yield. To get yield, you need to take risk. So if gold is not a commodity and it's not an investment, what is it? It's money. This is exactly where we started. But then you run into another problem, which is people don't understand what money is. And I just gave an example of that. They say, well, I have money in the stock market, I got money in the bond market. No, you don't. You have stocks and you have bonds. That's not money. A money market fund is not money. A bank deposit is not money. The government says it's money, by the way. When they define M1, M2, and these technical definitions of money, they call it money, but legally it's not. The only thing that's really money would be currency in your hand, and then everything from that on is one step removed. Physical gold in your possession is money. Currency is money. Could be euros, could be Canadian dollars, and so forth. So people don't even know what money is. And then they talk about money being backed by this or backed by that, or Bitcoin's not backed by anything. Bitcoin's a form of money, and so is the euro, and so is dollars, so are dollars, and so is gold. But it's all backed by one thing, which is confidence. If people have confidence that it's money, and they're willing to accept it in exchange for goods and services, and they're confident that if they accept it, someone else will accept it from them, then it's money. And if not, then it's not money. The problem with confidence is that it's very fragile, it can be lost quickly, and if it's lost, it's impossible to regain. And so all money systems are based on confidence to some extent. And what troubles me is that A, people don't understand that, B, they take confidence for granted, and in doing so they'll abuse the system, destroy confidence, and then what was money will suddenly become not money. But that won't happen to gold. Gold is the one form of money that people always have confidence in, and that's why you should have some gold.
I throw out a number like 98, 99%, and you say that's probably too low. You're probably right, and not only is it that the numbers are skewed that way, it's the people. It's the most prominent people, the most powerful people don't hold these views. And I take offense when someone like Warren Buffett says, well, you're just going to be there and fondling your gold. If you sit there and fondle your cropland, you're going to get no yield. Right. If you fondle your stock, any other type of quote asset, if you just fondle it and don't put it to work, it's not going to return anything, right? We have to combine and put things to work. I had a gentleman over here suggest the strangest question, because I told him I'd be interviewing you. He says, why does James Rickards do what he does? And it's kind of an interesting question, because you're in the club. You've been, I guess, educated in finance, traditional finance, modern economics, and there's perhaps a penalty to be paid for coming out and especially writing about gold. Is that a career limiting move? How long have you held these views, and what made you decide you wanted to? Because the burden is not yours, obviously, right, to get this up, but you want to. So why is that? Where did that come about?
Well, it's interesting because you're right in the sense that I have a graduate degree in international economics from a school that is basically intellectual boot camp for the IMF. I went to the School of Advanced International Studies in Washington, D.C., part of Johns Hopkins University. And when you graduate from there, you have a couple of career paths. You can go to commercial banking, go to government service, defense, intelligence, et cetera, or the IMF. The IMF was a big career path for people from my school. One of our alums was Timothy Geithner, former Secretary of the Treasury, but long before Geithner was Secretary of the Treasury, he worked for the IMF, and so that's a traditional career path. So I got that kind of education training, but most of my career was spent in banking in different forms. 10 years at Citibank, when it was actually it was the largest bank in the United States at the time, one of the largest banks in the world. I think there are a couple of bigger banks today, but at the time anyway, Citibank was the most prominent, the largest U.S. bank, the most prominent international U.S. bank, and I worked on the international side, worked in investment banking for a U.S. government securities. So my background was really in traditional banking, finance, government securities, sovereign debt. I was not a gold bug, as the saying goes. I haven't spent the last 30 years, sitting in my basement counting gold coins. The way I got to gold was precisely because I had a very good understanding of the international monetary system and a very good understanding of the structure of sovereign debt, that I started to look at it and I started to combine it with history, and I could see that it was not going to be repaid, that it was impossible to repay it, mathematically impossible, that the only way out was going to be some combination of default, inflation, taxation, confiscation. Those are all nasty words, but they're all just ways of stealing your money. I can steal your money by inflating the currency so you still have the money but it's not worth much, or I can tax you if I'm a government, or I can confiscate the wealth if I'm a nasty kind of government, or I can just not pay you if I'm Argentina or a lot of other places. There are a couple of ways out, 3 or 4, but they all amount to taking your money. And when I realized that, not coming at it from the gold side, but coming at it from the financial side, and then I said, well, I work hard for my money. What can I do to preserve wealth in that state of the world? And the answer was gold. So I kind of got to gold in a roundabout way, but then once I crossed that threshold and understood, then I began doing more research on gold. So this really, in my case, goes back to 2005. Before my first book came out in 2011, my newsletter started in 2014. So these have all, got a life at this point, a little bit of a shelf life. But my personal realization, if you will, goes back to kind of 04, 05. I was doing a lot of work for the U.S. government. I was working for the CIA and the intelligence community, doing financial warfare, threat finance. We were doing a lot of counterterrorism. We were thinking about ways that, if I were a terrorist, how would I move money, et cetera. And obviously gold always comes up in those conversations. So I kind of got to gold through, not through the mining route or the gold bug route, but through a financial route. But once I got there, I could see that this was the only way to preserve wealth, given the instabilities in the financial system. So then I started writing about it, and I felt, look, I love writing books, and I'm very happy when people buy books, but it's a little bit of a mission, for want of a better word, to get the word out to everyday citizens around the world, because the elites will not give you the straight story. And I've spoken to top officials at the IMF, U.S. Treasury, Federal Reserve, Bank of England, Bank of Japan, China Investment Corporation. I've spoken to a lot of government officials, academics and others all over the world. And, a private conversation is one thing, but what they say publicly is something else. And they either don't get it, literally don't get it, they can't process the conversation we're having right now, or they totally get it but can't say. And so I'm looking at, here's like the vast majority of all the people in the world. They're relying on their central banks, they're relying on their finance ministries and their treasury officials, they're relying on their elected officials to look out for them. They're being betrayed because those officials are either working with the wrong models or don't get it, or they know better and they won't say. So there's a great deception, a lot of lying going on, some combination of denial and outright lies. So I kind of took it upon myself to say, okay, well, whether it's a book or a newsletter or Twitter, I'm very active on Twitter at James G. Rickards, you can get the word out. What I discovered when I started doing that is that the appetite was huge. People were hungry for information. They felt they were being lied to. They didn't necessarily have the expertise to understand why, and why should you? If you're a successful auto dealer, dry cleaner, pizza parlor operator, you don't have to be a hedge fund billionaire. If you've been a successful auto dealer, by the time you're 60 years old, you're probably worth $5, $6, $10 million. That's a lot of money. You worked hard 30 or 40 years to get it, but you're an auto dealer. You're not a PhD in economics. And why should you be expert in all this? You rely on the banks, you rely on the government. So that trust has been destroyed. So now this individual, and I'm picking on auto dealers, but it could be a professional, a lawyer, doctor, dentist, pizza parlor operator, whatever it may be. That individual sitting there saying, okay, I'm 50, 60 years old. I've got 3, 5, 10 million in the bank. I don't trust my government any longer. I feel like I've been lied to. What do I do? And there's a big audience for that. If you can shine a light on, it's not like you can solve all the problems in the world, but if you can shine a light on, explain it to people, they really want to know, they really want to learn.
James, if I could interrupt just for a second, because all these ideas are going through my mind. First of all, I'll say that in my own personal experience, I'm a financial advisor. Many people have come to me and said, hey, over the years, I just read this book. Have you read this book called Currency Wars? And so many conversations for me have been initiated by that. You really have reached a lot of people, and you have to go decades back, I think, to find a book that was as effective as that. But on your comment about the people who don't get it, and we see that every day, that's not a surprise, but people in central banks and in that community who get it, it's kind of rare, and I'm not expecting you to put out any names, but that would be interesting to me to know just how many. Greenspan got it, but I guess consciously decided he was going to forget it. The gentleman from India seemed to be pretty sharp. The gentleman who stepped down.
Rajaran Raja.
How many of these guys are there, out there?
Well, it's not that many. I mean, you could almost come up with a list. So who are the international monetary elites? And they don't all get it, but some of them do. So who are they? Well, Christine Lagarde, David Lipton, Zhu Min, who just left, a few others at the IMF. So it's a small group. I'm not sure Janet Yellen does get it, by the way. There are people at the Fed. Lael Brainerd gets it. Stan Fisher gets it. Bill Dudley gets it. I'm not sure Yellen does. She's a really big brain, 160 plus IQ, liberal labor economist who was just married to her model. She's actually married to a Nobel Prize winner, George Akerlof. But she, I'm not sure she does get it, but the other ones do. Fisher gets it from a slightly more populist perspective, but I think he has good intuition about it.
The gentleman in Atlanta, I don't think he does.
Some of these regional reserve bank presidents, I don't think they do either. But I'm thinking more at the finance ministry, IMF, central bank level. I think the Chinese get it. I think the Russians get it.
Does Draghi realize how much damage he's doing?
Draghi gets it. Draghi totally gets it. But here's the problem. So you're in that position. You're Mario Draghi, or you're, let's give Janet Yellen credit, or you're Lael Brainerd or Stan Fisher or whatever. And you understand what we're talking about. They feel two things. Number one, they feel that they can fix it. So, okay, maybe the whole system's going to collapse, but we can save the day. We policy elites, we geeks, we PhDs from MIT and Harvard, we can save the world. So don't worry, it's all good. That's one, a little bit of denial there, but that's one facet. The other facet is, okay, maybe this thing is really hanging by a thread. Maybe this is way more tenuous. But if we say that, it will be a self-fulfilling prophecy. In other words, we have to be responsible about what we say, because we could start the panic that we fear. The very panic that we fear could happen and that we know perhaps will happen could be started by us if we speak honestly about it. So that's a strange job description where your job is to lie to people for their own good. I don't think there is such a thing. I think when you're lying to people, it's not for their own good. Maybe it's for your good if you're so inclined, or you're corrupt or whatever. But I think they have a sense of, I have to lie to you for your own good because I'm smarter than you are. And that's usually a pretty dangerous way to go about your business.
Okay, I know you got to run. There's a big lineup for you, James. Just want to get your quick thoughts on currencies. DXY, I think it's at around 97. It's been enjoying a lot of strength, whether it's deserved or not. What do you think about it for the next, say, 2 years?
Well, DXY is the most popular index for dollar strength. It's not the one I use in analysis. The Fed now that's the one that's traded, and people know the best. You're right about it, most liquid. But the Fed actually has an index. It's called the Broad Real Trade Weighted Index. So the problem with DXY is it's very heavily weighted to the euro, so it's almost a substitute for the euro-dollar cross rate. Whereas the Fed Broad Index has a lot more trading partners, and it's trade weighted, so it's a better reflection of how financial flows actually work around the world. So that's the one I use. Having said that, take any index you want, they're all showing a lot of strength. It's not what the Fed wants. The Federal Reserve wants inflation. That's no secret. Every speech they give, they say we have a 2% inflation target. They haven't come close in 6 years. And there's some reason to think they're moving in the wrong direction. Now, a weak dollar is inflationary and a strong dollar is deflationary because of import prices. And so if you have an inflationary goal and you have a strong dollar and the strong dollar is deflationary, how does that work? Well, the answer is it doesn't work. So they have to weaken the dollar. So my expectation is that over the next year, let's say, I would look for stronger yen, stronger euro, weaker dollar. I think the yuan dollar peg will be kept in bounds, but a weaker dollar means a weaker yuan. Like if you peg to another currency that's weakening, then you're weakening too relative to other currencies that are out there. So I would look for, again, a weaker dollar, weaker Chinese yuan, stronger yen, stronger euro, higher dollar price for gold. Because I think when I say gold is money, let's put gold in the conversation when we're talking about cross rates. So that's how I see it playing out. But you know, with volatility along the way, and then you can always get a surprise like a Brexit or a Turkish coup. These things tend to make the dollar stronger in the short run, even if the Fed wants a weaker dollar in the long run. So you know, there's always volatility.
Does a strong, weaker dollar mean a strong equities market in the U.S.?
In the short run, yes. In the long run, no. And the reason for that is a weaker dollar. How do you get to a weaker dollar? Well, one thing you do is you don't raise interest rates, because raising interest rates would give you a much stronger dollar. So Wall Street loves free money. So if a weak dollar policy means interest rates are on hold and maybe even they cut back to zero, Wall Street will like that. The problem is that in the longer run, you will get inflation. There's not a lot of inflation right now, but you will get it if you pursue this policy long enough. And inflation is very bad for capital formation, which at the end of the day is bad for stocks. So the stock market looks a little toppy right here. It could go a little higher based on this weak dollar scenario, but at the end of the day, you know, fundamentals will reassert themselves, and as I say, either the inflation will come or the stock market will pop. But one way or another, intermediate to long term, that's pretty bad for stocks.
Okay, I guess we'll wrap it up here. I've been speaking with James Rickards. He's the author of Currency Wars, The Death of Money, and of course the new case for gold. James, where can people find out about your two newsletters?
My publisher is Agora Financial. I have my main newsletter is Strategic Intelligence. It comes out 12 times a year. I think it's great value for money. It's fairly inexpensively priced with a lot of content. We have some more specialized, more expensive products. Rickards Gold Speculator is doing very well, and I've had readers write to me saying, "Thank you, you paid for my kids' college tuition." So that's always great to hear. So that's having a good run. So, and then I'm also very active on Twitter.
Okay, so check him out at Agora, and your Twitter handle is?
At James G. Rickards.
At James G. Rickards. This is Albert Liu at Vancouver, Sprott, Natural Resources Symposium with James Rickards. Thanks a lot for joining me today.
Thanks, Albert.
Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.